Reliance Industries on Friday reported a 22.5% year-on-year growth in its consolidated net profit to 16,203 crore rupees for the quarter ended March. In the corresponding quarter of the previous financial year, it had reported a net profit of 13,227 crore rupees. RIL's consolidated revenue from operations jumped 36.8% YOY to 211,887 crore rupees for the reported quarter. The oil to telecom conglomerate also reported a record annual consolidated net profit of 67,845 crore rupees for the financial year. There have been more instances of corporate results beating estimates than missing them during the Q4 FY22 earnings season so far. This was the finding of a recent ICCI Securities Limited report. Thus far, the bulk of the results declared in Q4 FY22 have been from commodity consumers, such as industrials, auto, and consumption, along with services such as financials and information technology. According to the report, while the impact of commodity prices was relatively less on the services sector, it has its own cost challenges, such as the high attrition rates at IT companies. The report highlighted that instances of corporate results beating estimates have exceeded the misses within the NSE 200 universe, and particularly so in the mid-cap space. As on 4th May, most commodity producers were yet to announce results, especially from the oil and gas sector. The report said that they could likely tilt the scale further in favor of more beats than misses going ahead. It indicates that commodity consumers would continue to feel the pressure of rising input costs in subsequent quarters. A variable to watch would be the continued ability to pass on the inflation, which in turn would be a function of the demand environment. So far, the Q4 FY22 results have indicated that the mean reversion of aggregate corporate profits, which began from the decadal low point of FY20, was intact. The ICICI Securities report expects corporate earnings growth to beat nominal GDP and act as an inflation hedge. On average, corporate profits are expected to grow in the range of 15% to 30% over FY22, FY24E. The Nifty 50 is likely to grow at the lower end of the range. Meanwhile, higher growth will emanate from the mid and small cap stocks. The report said that the higher growth would be attributable to the larger impact of COVID on the mid and small cap space and the rapid reopening of the economy, which was likely to show higher growth on a depressed base. Jyotivardhan Jaipuria, founder and managing director at Valentis Advisors, said that near-term earnings could see some margin pressure and some downgrades as high commodity prices cannot be passed on immediately. However, he added, this would benefit commodity producers which have an equally large weight in the index. Hence, overall earnings downgrades might not be high. Jaipuria said, for sectors like cement and other home building sectors, when near-term earnings would be under pressure due to the spike in commodity prices, the fall in share prices offered investors an attractive entry price. The financial sector, where Valentis was underweight during the COVID crisis, was headed for better days, as the economy was recovering and a lot of the NPL provisioning was behind us. Jaipuria also said that while auto was an underweight sector too, things stood close to the bottom of the cycle and the sector could see sharp earnings growth over the next few years, especially as the chip shortage eases.
As of now, the demand destruction that has not yet happened. Because if I just give a color, say demand destruction has, inflationary-led demand destruction has already happened in Europe and UK, wherein the buzz of recession is quite strong out there, which is quite visible. But the same thing, which is inflationary-led demand destruction in India or the US, we have not yet seen that. It's a little early, because I think even the companies, when they are reporting numbers or even the commentary which they are giving, it's primarily focusing the volume growth, the revenue growth will be there. But on the margins front, they are still there is uncertainty which is there. There has been a price hikes, but eventually it's like they have to take a further hike in the month of May, and that is basically the situation right now. But apart from that, even the companies which has reported weak set of numbers, there has been a top line growth. It looks like as of now we will end this quarter with the maybe in line at an index level, or maybe marginal earnings cut will be there at an index level I'm talking about. If you look at 15% kind of earnings growth, as of now the risks are on the downside probably as we move ahead, and all eyes are on the inflation, how exactly this particular data pans out. In terms of the GDP growth rate estimate, which we all are working, it's ranging from 7 to 8 odd %. And with that in background, and I think it looks like double-digit growth rate for Nifty will be still be there in the market. So still, I'm hopeful for a double-digit earnings growth for Nifty 50.
India Inc. is confident of sustainable growth in corporate profits due to low leverage effects, the earnings beating estimates, and the nascent signs of an improving investment cycle.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.